Joining us to talk about this and your macro market setup is Mark Avallone, president at Potomac Wealth Advisors. It is, Mark, a historic day. Some might say it's a sad day for the free markets in a sense. What do you make of the Fed's actions, and do you think that this has been part of the rally that we have seen the last couple of weeks?
Good morning, Brian. It's good to see you back. I think that this is why the market has been up. And if they didn't follow through at this point, it would have been a real setback. This is a Fed rally. This is not an earnings rally. It's not a COVID-19 recovery rally. This is all about the Fed. So them in the bond market is setting a floor. It not only salvaged what we saw, some carnage in the bond market. On the municipal side, we even saw it there. So when they stepped in, when they said they were going to start buying, that's what set the floor on the market, both for not only bonds, but also for stocks. So it's good they're following through today.
Yeah, and listen, with all due respect to all the other coverage out there, it's been a lot of talk about the, quote, reopening rally. I think if it was a reopening rally, it would have been a lot more targeted to the companies that might actually benefit from the reopening. That is not what we have seen, Mark.
Right. It's been a bifurcated market, and that's what concerns me going forward. Look, there's a huge segment of the market that is benefiting from this tragedy, and that's the names we all know, the stay-at-home space, the shop at home, everything cloud-related. But there's millions and tens of millions of jobs that are going to be affected, not in those spaces that are slowing down. Main Street will be severely impacted, and then that has trickle effects to the credit markets and to banks, to commercial real estate, the real core of the economic engine. And when banks slow down, when credit tightens, that will slow down the economic growth and the recovery for everyday workers, for businesses that want to start back up. And I think that's why investors should pause here. Even if we get the best news on the treatment and the vaccine, to restart and to get investor expectations, lender expectations back to where they were, that's going to take time.
You look at sectors of this economy, too, like we just talked about, Mark, and I mean, it is, to your point, very bifurcated. Real estate, utilities have been a huge winner. Now they are the worst performing group over the last couple of months, despite the fact that, yeah, power use is down, but it hasn't exactly collapsed off the charts. The market does seem to be picking its winners, and those winners are, A, the winners that had been the winners before the pandemic, and maybe ones that are going to benefit from the Fed. So what's an investor to do? All cash?
That's the tough question. I think the first thing you do is don't get out over your skis and change your risk tolerance because you see the NASDAQ 100 soaring to new heights. On the other hand, this is what makes it so difficult. The valuations of banks, even though we think there's going to be trouble ahead in the financial sector, on a valuation basis, they're certainly trading more reasonable. So I think very broad diversification is the key, but I would caution investors about the risk profile. There's nothing wrong with not being greedy. Greed eventually replaces fear for investors. And that's the real enemy right now if you're sitting on a retirement plan. Include tech. They're going to continue to run. Don't ignore the other sectors, though, and overweight into just the NASDAQ 100 and what's been working. The market's too broad for that.
People have been. We're going to show people just how much of the second half hour. Mark, some sage advice there early in the morning. We need it. Says it's likely a Fed-based rally, not earnings-based. Mark Avallone, thank you very much. Have a great day.